Let's get started. So today, what I really wanted to do was talk about passive income, specifically passive real estate. Now, you and I just got done with a conference, your conference in California, that was all about real estate, both passive and active. But one of the most fun parts for me was moderating this debate between a couple of docs who love passive real estate and a couple of docs who love active real estate. But for the viewers today, can you explain a little bit about the difference between active and passive real estate investing?
Sure. I mean, I like to think of active versus passive as more of a spectrum than a black and white thing. I mean, there are ways to make certain aspects of real estate a little bit more passive, and certain ways to make a little more passive real estate a little bit more active. Usually the defining line, though, is whether you're a landlord or not. Whether you actually own the property and are the landlord, then it puts you in the active category. If you are not the landlord, then it usually puts you in the passive category. But again, it's mostly a spectrum. So I kind of talk about whether you own your own properties, right? Whether you manage it yourself or you have a property manager, that's really considered a little bit more active. When you invest in somebody else's deal, whether it's like something called a syndication, whether it's called a fund, or whether it's in some of these REITs that you might have heard about, you're investing in someone else's deal. And once you invest, really, you have no other responsibility except to sit back and wait for dividends. So that's usually considered a little bit more passive.
Now, a lot of investors are familiar with the concept of a REIT, a real estate investment trust, often from their experience investing in publicly traded REITs, such as those in the Vanguard Real Estate Investment Trust Index Fund, or perhaps on the mortgage side, something like the iShares Mortgage REIT Fund. How is what you're talking about different from those publicly traded stocks that are REITs?
Yeah, when I talk about syndications and funds, and we can talk a little bit about that in detail, but those are more private type deals where you actually, even though you're invested in them, you actually own shares of the actual properties, versus oftentimes when you're investing in these REITs, these publicly traded REITs, you buy shares and you own shares of the companies that own a lot of these properties. In this case, there's something called a syndication. You might have heard something about that, but I'll be honest with you, even to people that I talk to in my group, and we talk real estate all the time, over half the people have no idea what I'm talking about. When I mention the word syndication, they often kind of talk about crime syndicates, mafias, syndicated TV shows, and that's where they probably use.
How can we invest in the mafia? Is that an option?
I would love to. You're not connected to them. You're connected to everybody. Is there a mafia in Utah? Anyways,
I'll bet there's a mafia blog out there. Maybe.
That's right. Let's buy them up, huh? So the syndication, what it really means at the core is it's a pooling of capital or pooling of money to purchase a property. For example, there's a large property. I always say the most famous one of these is the Empire State Building. At one point, it was purchased as a syndication. Someone came up with a great idea that we should purchase the Empire State Building as an investment. The problem is they didn't have necessarily the funds to buy the whole entire building. So they said, let's get investors in there together, and I'll run they'll run the deal, but other investors can come on in and everybody can own a small share of the Empire State Building. And so that's what happened. And that's kind of what a syndication is. And so whenever I look at the Empire State Building now, I can't get that out of my head. It's a big syndication, or it was at one point. And so that's really the pooling of funds. And when you do that as an investor, most likely you and I are not actually running those syndications. We're investing in those as physicians or high income professionals. We actually are buying a piece of that deal and buying a piece of that, essentially, whether it's an apartment building, office, retail, or buying a piece of that. Now, there's something called a real estate fund, which is essentially a lot of these apartment buildings put together and put under one fund. And I always say if a syndication is kind of like a stock, it's an individual building. A real estate fund is more like a mutual fund, a bunch of these buildings put together under one umbrella.
So what's the point of doing a syndication? I mean, why not just buy the properties yourself? Why would you have to pool money with other people?
Well, it depends on what your goals and objectives are. I mean, do you want to be a landlord or not? That's really what it comes down to. Do you want to own your own apartment buildings, and what kind of capital do you have to purchase those apartment buildings? And, ultimately, what kind of experience do you have? How comfortable are you with that? How much time do you want to put into this thing? How much hassle do you want to deal with? Now, to be honest with you, a lot of people put it in, again, you have to be all active or you have to be all passive. Personally, I do both. So there are apartment buildings that I own personally, And then there are other people's deals that I invest in because it's such a good deal, but I don't have access to those deals personally, and I don't have the money to buy some of those deals. I mean, I know some people that, invest in some of these syndications and funds and apartment buildings, and they are able to diversify all across the Midwest, buying 150, 200 unit buildings. And ultimately, these funds put together $250 million to purchase all these properties, get great diversification. They have the whole vertical from, the operators to the managers to the construction, and they're able to really manage all this and have it like a fine-tuned, machine. I don't necessarily have that capability. When I own my own properties, I have to find my own property managers. They have to call me when there's issues, and which is fine. I love that aspect of it too. It's a little bit more DIY. And I think a lot of people in this group, they love to do things on their own, kind of get their hands dirty and run their own business. In that case, that's what happens. And that's what I get out of owning my own rental properties. But I only have so much capital. So I can't go out and buy a $10 million building, that sort of thing, or $20 million building necessarily, not yet, right? And so oftentimes I find these other deals. And so I'll say, okay, I'm able to give whatever, whatever they're looking for to kind of jump in with all these professional operators.
So let's talk a little bit about how these deals are structured. Okay, let's say you're going to buy a $20 million apartment complex. What's the typical structure of that? Presumably some of the money is borrowed, and then some of it comes from the participants in this syndication. What's the typical structure there?
Well, there's somebody who puts together the deal, and they might be called, I don't know, one of 4 or 5 things. It might be called a sponsor. They might be called an operator. They might be called a syndicator. They might be called a general partner. They also might be just called a manager. So any of those terms, you might read those. At first, I got really confused because I'm like, what's this versus that? It turns out they're all basically the exact same thing. It's whoever's running the deal. And they're the ones that actually create the structure of the deal, create the business plan, create the vision for this thing. And then they find investors to come in and help support them and invest the capital. Now, usually they are using leverage. Just like you and I would, if we bought an apartment building, most likely we'd be putting money down, just like you do with your own home, and using the bank's money for the rest of it, right? To leverage, to kind of buy yourself a little bit of a better property. And so they usually will use leverage, but they'll have to get that down payment and the cost for some of that construction or rehab right off the bat from investors. And oftentimes they're investing alongside with you as well, whether that's 5 or 10%. And usually they make up about 90% of that from the investors. And so you are what's considered a limited partner. And the reason they call it limited is you're really limited in terms of your decision making. Like you just don't have the opportunity to kind of decide when to sell, how to rehab it, and this sort of thing. You're actually, along for the ride as a passive investor. And so that's how it's usually set up. And there's usually in terms of returns, always people are like, okay, what do I get out of the deal as a limited partner? Like there are a couple different, again, everything is structured completely different. There's really no 2 deals that are exactly the same. But what they usually do is with your capital, they usually give you some sort of promised preferred return on that per year, meaning that out of the returns or the rents and the income that they get, they usually will give you out a certain percentage first. And then after that, then there's a split in terms of the rest of the money to some to them as general partners and some to you as well. And so you just have to understand and navigate what that whole return structure looks like to see if that matches your goals.
Very cool. It seems like they use something like 2/3 leverage on most of these deals. So, $30 million apartment building, they're going to borrow 20 million. They got to come up with 10 million from typically 100 investors, because that's a lot of times how many they put into an LLC. So they go out and raise this money and people chip in 25 or 50 or $100,000 a piece until they get that 10 million, and they go out and buy the apartment. You pay some fees to the general partner, this operator, and basically you do nothing except cash the checks for the next 5 to 10 years or however long that deal goes. Is that pretty much how it works as a limited partner?
Yeah, that's the hope. So I tell people, they say, is it truly passive? It is once you invest. Once you invest, literally you sit back and wait. But the hard work is really up front in deciding, who do I invest with? Why is this, not just who do I invest with, is this deal the right deal to invest in? And does it really match my goals? And it's something I'm excited to kind of invest in, or should I not invest in it? So all the work really comes up front, before deciding all the due diligence, vetting out the deal. Then once you're in, you're kind of in for the long haul.
Very cool. So, it's pretty interesting. I've probably invested in 21 of these, I think, at this point, in some form or other, whether it's via a fund or via syndication. Obviously, a lot more properties than that. But a lot of people have this question, why should I bother looking at these private investments compared to just buying a Vanguard index fund, a Vanguard real estate investment trust index fund even? What is the benefit of going into the private world?
Well, there's some really great tax benefits, number one, that are not available to you as an investor in a REIT. What happens is there's something called depreciation in real estate. Right off the bat, meaning that the government allows, everything in a building. For example, let's look at your home. You look at everything around you, the walls, the roof, the carpet, everything inside your building there or inside that has a lifespan. And the government understands that, and they give you basically tax write-off every year to deduct for the expenses, right? That thing has a lifespan. And so what happens is, especially a lot of these private deals, especially when you own rental real estate, you use that depreciation every year to do a write-off. And what happens is it offsets some of the gains that you've had that year. So what happens to me is that when I get these returns or my tax returns at the end of each year, even though I've gotten that cash dividends throughout the year, the distributions, at the end of the year, my total is usually, it's not a profit. It usually shows a loss. So I usually show a negative number at the end of the day on my K1. And that's because of this depreciation. And why that's nice is I can use that. Number one, I don't have to pay taxes on that at this moment. And number two, I'm able to maybe offset some of the other gains that I might have gotten from real estate. Now, if you get really fancy and you happen to not work as much as a physician, or you happen to have a spouse that maybe doesn't work as a physician or doesn't work at all, and you're able to acquire and get something called real estate professional status, then you can actually offset some of your physician income with that as well. And that's where it becomes really, really powerful for a lot of people. So if you understand how to kind of harness a lot of the tax benefits when it comes to a lot of these private deals like syndications and funds, to me, that is a huge benefit. And for number two, I think it's just a great way to diversify. I mean, personally, I have REITs as well. I've invested in REITs. I've invested in index funds. I've invested actively. And I also like to invest passively in these private deals. And so for me, I like kind of having my hands, eggs kind of spread around, just in case, because different markets do different things. I mean, again, there's a lot of argument over this, whether REITs are a little bit more correlated with the stock market versus some of these private deals. And I would probably beg to argue that a lot of these private deals actually have a lot less correlation with the stock market. So in terms of diversification, it can be a great thing.
So you get the depreciation, you get the diversification, you get to invest in stuff that's not available publicly, right? I mean, a lot of these properties are not publicly traded. You simply can't buy them. They're not included in the Vanguard REIT index fund. But talking about these tax benefits, this is a good chance. Let's bring in a question here from James Wax on the Facebook group. And he's got a question. He says, I only have one syndication investment, a fund. I've had it 1 year. It generates a K1. Okay, that's to be expected. In my tax return, my CPA prepared a Schedule C, and it showed that I had $57,000 in qualified net loss carry forward on a $37,000 investment. I'm in the 32% tax bracket. How was there more loss than the actual investment? Why wasn't I able to take any of that $57,000 loss last year? Is it because it was a passive income distinction? Now, I had a similar experience with one of my funds. You want to explain that?
Yeah, I mean, from what I can see, yes. I mean, number one, just to kind of tackle that last part of that question, why weren't they able to kind of realize that loss and offset? I'm assuming their active income.
Yeah, I think that's what he's getting at.
That's really what he's getting at.
Yeah.
So I think kind of going to the history of this is that back in the day, a lot of physicians, high income professionals back in the day what they would do is they would invest in real estate, take this depreciation loss and offset their active income. And the IRS got kind of smart to this and decided, all right, this is something that's not good for us. And so what they did is they kind of created this wall between active income and passive income. So your active income is kind of like your day job income. Passive income is often in the bucket, like real estate is in that bucket. And they made it so that you cannot use those losses on the passive side to offset your active. They can only offset the passive within the passive, okay? And so that's why you end up carrying it forward, because you cannot use it and cross that kind of wall, okay? Now, that's where I started talking about the caveat before, is that if you have something called real estate professional status, and we could talk about that on another time if you want, because that kind of is an interesting topic in and of itself.
Yeah, for anybody with an extra 750 hours a year.
Yeah, I mean, you'd be surprised, but it doesn't have to be you. It can be your spouse,
right? Which
is the amazing part. So it can be your spouse, but collectively, if you guys file, anyways, we can talk about that later. But that's when passive income for that 57 for this gentleman, let's say, can be used to offset a lot of your active or physician day job, whatever it might be, right? So the reason you show that type of loss has really to do with the property that was bought through that. And they're able to write off What's really cool is we just did that. There's something called depreciation that was put into recently through a lot of the tax laws that have come about, where they're usually able to take a property, for example, let's just say it's a multi-family property. They usually spread that cost out over of the building and of this, whatever it might be, over 27 and a half years. So what they do is, let's say you just take the purchase price of the building or whatever that building might be, the value of it, you divide by 27 and a half, and every year you can deduct that amount. Well, what happened with the tax law is the recent tax law is that you were able to squash a lot of that 27 and a half, a lot of that into just a few years. And so what happened is that people were able to take these humongous chunks of depreciation, and especially on the front end. And that's something that people have been using to really kind of offset a lot of the taxes, and especially for a lot of these syndications. Man, it's in their benefit because they're usually only holding these, these only investments for only a few years. So they're taking advantage of that. And this is why you might see such a huge loss, is because of this bonus depreciation that's happening.
Exactly. So, James, the reason why you have depreciation that's greater than your investment is because the depreciation applies to the entire building, even though a lot of the value of the building was borrowed. So that's why your depreciation can be bigger than your actual investment was. But the benefit of that is, even though you weren't able to take that loss this year against your active income, you basically sheltered years of passive income from this investment with that depreciation. And so each year you'll use up a little bit more of that, but any income you got from that investment this year was totally tax-free, at least in this year. And obviously there's some rules at the back end that can be recaptured if you don't exchange properties, but it's really the main benefit of real estate investing, and you just can't get it when you're investing in these publicly traded real estate investment trusts. So it's really pretty powerful. But imagine if you had multiple properties, one of them had already been depreciated, and now you're getting all this taxable income from it. But if you then get this new investment that kicks off this bonus depreciation, $57,000 in bonus depreciation, you not only covered that investment's income, but you covered the income from a bunch of your other private real estate investments as well. So that's the real benefit tax-wise of getting into the private world, and it is substantial. And sometimes people blow over it a little bit, on the Bogleheads forum. You gotta fix toilets at 3 a.m. But the truth is, there's some very real benefits of real estate investing that you can't get by going through publicly traded investments. I mean, it's one of the best investments to leverage. It's one of the best investments for tax benefits, just because of that depreciation benefit. And especially if you can take advantage of exchanging your properties, you may never recapture that benefit at all until you get the step up in basis at death.
Yeah, I think one of the things to mention here is that I think people ask whether you can actually take part in a lot of these tax benefits by investing in passive real estate. I mean, a lot of people say, okay, you can really only take benefit, if you're investing actively. And I think this just goes to show that, yes, you can see it as well. It gets passed down to you as a passive investor as well. You truly do own a part of the building, and that's what it is. So a lot of people are able to strategically use this. Every couple of years, they might invest in a huge one of these to offset some of their active income. Some of their more passive or passive gains that they might have.
Yeah, it was pretty interesting at Peter's conference. One of the physician couples that spoke was talking about how they'd literally paid no taxes for the last 2 or 3 or 4 years. And the reason they were able to do that was one of them was qualifying as a real estate professional. So they were able to offset their physician income of their partner with that depreciation. And so can you imagine, making several $100,000 a year and not paying anything in income taxes? That's pretty attractive to a lot of people. And that's what gets them excited about real estate. Now, a lot of people don't realize with these investments that you have to be an accredited investor in order to invest in them. Can you explain what that means? What's an accredited investor, and how can these 87 folks watching this Facebook Live become one?
Yeah, I mean, this really has to do with the SEC. The SEC put this in place because they're essentially they say they're trying to protect investors in this type of case. And they want to make sure that investors who are investing in these private deals not only have the capacity, but the sophistication to be able to invest in these type of deals. But what it really comes down to really has very little to do with the actual knowledge or experience. What it has more to do with is really your income. So if you want to qualify as an accredited investor, there are actually a bunch of qualifications, but the major ones that you need to know about are either you need to make $200,000 a year individually, for the last 2 years and expect to make that ongoing as well. Or as a couple, you make $300,000 for the last 2 years and ongoing as well. Or you have $1 million of net worth, excluding your primary income. And those are the three major ones. There are some other ones, but those are the three major ones that if you qualify by one of those three things, you're considered an accredited investor. Now, nobody, when you reach that status, nobody sends you any sort of badge or certificate. It's just that when you go to invest in some of these things, they will ask you, are you an accredited investor? And how are you going to prove it? So they make you ask, check a little box by either one of those things, 200,000, 300,000, $1 million net worth. And sometimes they have your CPA sign off on that just to confirm that that's the case. Or sometimes they'll ask you for your tax returns, but I just prefer my CPA to sign off on it.
Awesome. So, the interesting thing about being an accredited investor is the idea is you can lose your entire investment and it not kill you financially. And the assumption is that you know how to actually analyze an investment and decide if it's a good deal or not. But they don't actually require either of those things in order to call you an accredited investor. All they care is that you make a bunch of money or you have a bunch of money. So
exactly.
There's a little bit of a disconnect there, but that's what an accredited investor is. The good news is almost every doctor out there either already is an accredited investor or soon will be. And so it makes sense for these investments to talk about them amongst doctors just because almost everybody can invest in them. But if you go to the general pool of Americans, most people can't invest in these things. They're kind of special that way.
Yeah.
And, in some ways, some people might argue, well, they're special because people are just ripping off doctors. But I think there's a little bit more to it than that. Let's talk a little bit about your course. Now, you put together a course because people, are starting from the place where they don't even know what a syndication is. And now all of a sudden they're supposed to be sophisticated, accredited investors able to choose between these investments and decide how to allocate dollars to these private real estate investors. Can you explain why you designed this course? I mean, every course really has a transformation. That's the goal, to take you from one place to another. And what is the transformation you're trying to accomplish with this course?
Well, let me tell you how it first started. I started talking about some of these passive real estate investments that I started investing. And the most common question that I got was, how do I figure out how to do the proper due diligence for these type of deals? How did you figure it out? And for me, I thought about my journey. I was like, you know what? I just did it by trial and error. I mean, I read as many books as I could read, but they were all pretty confusing. The jargon and that sort of thing took me a while to get up to speed. I was studying that stuff just like I was studying for the boards, and it took me forever to really try to figure out how to do this. And I was talking to some of my friends who are investing in some of these things, and I said, how are you doing the proper due diligence? And they said, they tell me, honestly, I just kind of do it because this person told me and cross my fingers and hope for the best. And I kind of took that situation. I said, this is not good. We need to know how to do at least, just as much as knowing what deal to, invest in. We should definitely know what deals not to invest in, because I'm really trying to help people avoid mistakes, if anything. And so I started thinking about, okay, what is a clean pathway and kind of a given roadmap for someone to kind of evaluate one of these deals? And can I put something together? And so honestly, it took me about a year to do this. But the goal of this whole thing is to help you get from zero to little knowledge on these passive real estate investments and to get to a point to be able to confidently invest in these in about 4 weeks. Okay, to kind of take you from the beginning to confidently investing in 4 weeks. Now, that's kind of where we started. But the problem is, after we had some people go through this course, they said, okay, we have this knowledge. Now, where are the opportunities, right? And, we like the community. There's a community aspect to it. And they're like, we want to keep this community going because we're learning from each other and somebody's seeing something that I'm not seeing. And so we actually put together on the back end of that, and this is brand new for this version of the course, we put together an investor club for that. And so what it allows is for people who've done the course to come in there and afterwards to be able to talk about deals, to present deals to each other, show people deals, and actually vet them together as a group and really continue the learning and kind of work together with that newfound knowledge. And so the goal is to get from, again, not knowing what you're doing with these passive real estate deals to understanding the language, the jargon, to be able to see them, to be able to decide what, whether it's a good deal to invest in or whether it's a good deal, whether it's a deal not to invest in, and then just continue learning and have this community.
Now, it's a 4-week course, and I believe there's 4 modules in it. Can you talk about what the 4 modules are and what you learn in each one of those?
Yeah, again, it's our my opinion, it's kind of our roadmap to this thing, to learning how to do this properly. Number one, the first week is really a kind of getting up to speed. We talk about all the the importance, the goals that you might have, the importance of investing in real estate, talking about all these syndications funds and talking about the different passive real estate investment opportunities and kind of teaching you what those might be. That's the first week. After that, we start digging into the deal and what I consider the three most important parts of the due diligence. Number one, you have to know how to vet the sponsor or the operator. Who's running the deal? And to me, that is absolutely the most important thing. Who are you investing with? Because again, a building's a building, but who's going to run it? What kind of business plan do they have? Do they have a track record of executing, right? And what are they going to do? And how are they kind of planning for what might be an economic downturn or having problems? How are they going to deal with that kind of stuff? So that's important. After that, we also talk about the market, understanding, because real estate is very, very local. Like a building in one little area might do great, but another one might do poorly at the exact same time, depending on economic factors, population growth, that sort of thing. So how do you evaluate that market? And then lastly, like, how do you evaluate the deal itself? Because the deal comes with so many different things. It's not just a building. It comes with, like, what their plan is, what the returns are for you, what the fees are, and how to understand and read all those things. So we put all that together in 4 weeks. And really the best part about this is we added another little curriculum. Besides the Investor Club, we added a small curriculum in there called Personal Finance and Physician Wellbeing. And we did that because we wanted to make sure that we kind of brought it into the bigger context, and we wanted to allow people to get CME from this. So there are 5 CME credits that are available to people who take this course as well. So that's been one of the newest additions and something I'm really excited to be able to talk about.
All right, so let me show people where they can actually sign up for this. I'm going to pull you down from the screen for a second, Peter. He hasn't gone away, but I'm going to pull you down, and I'm going to pull this up so they can kind of see my screen here. And as you can see there, we're going to go over here. Whoops, wrong way. Let's go this way. Let's go here just to the White Coat Investor site here. And you can see I've got a link up right now for this week, since this is the only week is enrolling in the course. I think the last day is the 11th or the 12th. Okay. All right, so if you go to the whitecoatinvestor.com, you can click on this link. That will take you to Peter's information page. He's specialized it just for the white coat investors. And the reason for that is if you actually sign up through this link, you get a free copy of my latest book, the White Coat Investors Financial Boot Camp. I'll sign that and we'll send that to you personally if you sign up through here. Be aware this course is also available for 5 CME credits. But as you go down here, you get lots of information about the course. Down here, it even tells you about the modules and what each module has, about the sponsors and the money and the market and the property and all that. It gives you all the extras, talks about the free book, and goes through the pricing down here at the bottom. And that is how you can buy it. So let's bring Peter back in here. Let's bring that down, and we'll bring Peter up. Sorry, playing with the new software. This is all new to me this week, so this is fun. All right, we got Peter back here. So I showed them where they can buy this thing, Peter. You were mentioning some of the extras they get and how this really isn't open all the time, that it only opens once or twice a year. And, the enrollment periods are usually just a week or two. And so through the 11th, you can buy this course. You got to go through that link to get the special White Coat Investor deal. But this is your opportunity to not just be an accredited investor because you make 200K plus, but to be an accredited investor because you actually know what you're doing, which is the whole point of being an accredited investor.
Yeah, I will tell people if this thing keeps you from making one poor decision when it comes to these investments, then that will have paid for itself many more times over. And the thing is, I want people to really love this and kind of make sure this is right for them. And so we put a guarantee in there as well too, so that people feel like they have an opportunity. Really, there's no risk involved. We're giving them a 14-day money back guarantee. So essentially, you are going to see half of the course. You're going to see 2 modules, and you're going to go through it and say, all right, maybe I gave it my all, but this is not for me. And that's fine. We want people to be in the course that really want to be in it. So just let me know and we'll give you your money back. That way there's no risk in it. We want people to get in there and just love it and really get a lot out of it.
So basically you get half the course for free. So sign up today. There's seriously no risk. If you're willing to put the time in, sign up for the course. And I think if you're interested enough to go through 2 weeks of it, you're probably going to want the other 2 weeks as well. And obviously, if you stick with the course, I'm going to send you a free signed book of the White Coat Investors Financial Boot Camp. All right, let's see if we got any other questions here to answer from the readers or the listeners, the watchers, I guess they are here, the viewers. That's what we should call you. I got a follow-up question from James Wax. He's wondering more about this passive loss he's carrying around. He's wondering if it can be used to offset passive returns from stocks and bonds. That's a good question. I don't know that answer offhand as to whether you can use depreciation to offset your dividends and your capital gains. I'm pretty sure you can't your capital gains.
The dividends,
I'd have to look it up. You can offset your real estate income from it, your rents and so forth from your real estate. But I don't know if you can use it to offset the dividends. And I'm not sure you'd want to, because those dividends are already qualified. You're already getting a better rate on those. Same thing with long-term capital gains. But that might be a good subject for a blog post, because I don't know the answer to that right off. That's the problem with these lives, right? I can't get all the answers beforehand, so I look really smart. I just get put on the spot, and sometimes I just don't know. And I think that's the case with this one. You don't know the answer to that, do you, Peter?
No, I don't know. I have a feeling they can't, but yeah, I have a feeling they can't. But let's go to Dr. Google or whatever for that later.
Yeah, or maybe one of the 60 people watching this can chime in and let us know what that answer is if they know. We got another comment here from Christian Davis. Just signed up for my first syndication. That's great. And congratulations. We'll see you at the White Coat Investor Conference. Peter's going to be there as well. He has a talk at the White Coat Investor Conference in March. If you're interested in that, by the way, you probably ought to get on the waiting list. We went through more of that waiting list than I thought we would. And most of the people off the waiting list are going to be coming, and maybe all of them. So if you're still interested in that conference, get on the waiting list today, and you may still get to come.
Yeah, absolutely. Especially if anybody else out there plays foosball. Apparently, we're going to be challenging some people in foosball, Jim and I. So we'd love to get you out there if anybody else plays.
Yeah, for sure. That'll be a great time. So I promised Peter I wouldn't take up more than about a half hour of his time tonight to bring him on here to talk about his course and to talk about passive real estate. So we appreciate the questions. We didn't get a lot of them tonight, but that's fine. We didn't have a ton of time anyway. We'll come back and talk more about real estate in the future. But if you're interested in this course, check it out. You can see the link to it scrolling along the bottom of the screen. I tried to make it really easy, whitecoatinvestor.com/passive, and check it out. Seriously, nothing to lose. It's an awful lot like my online course, the Fire Your Financial Advisor course. If you don't want it, you get your money back. And so I know these things are sometimes a little bit more expensive than just buying a book, but the reason for that is you're getting a lot of personal instruction and community, and guarantee that it's really going to provide you value, or you get every dollar back. So check that out today. Peter, thanks for coming on. Thanks for your time. And thanks for putting this course together, because there is a real need in the physician financial community for this sort of information.
Cool. Thanks for having me, Jim. Thanks, everybody out there. Appreciate it.